But let's come to this part of the discussion, assertions. Because if you remember back to my diagram, I said the assertions being tested could guide us on the audit procedures we are going to be undertaking. Whilst we undertake the audit procedures, we are going to be gathering audit evidence, and that audit evidence will help us to now express an opinion on the financial statement, which is going to be in our audit report. So we've looked at the various audit procedures we undertake. We just looked at the qualities that the audit evidence must have. Now, let's look at the various assertions that can be tested for. And this is where everything is crystallized. Because when you read the question or you read the scenario and you're able to conclude and know the assertions that you are supposed to test for, that will help you to then know the procedures you are going to be carrying out so you can gather your evidence. So let's come to the assertions. So what are assertions? Simple. Assertions are characteristics that need to be tested to ensure the financial records and disclosures are correct and appropriate. So the things that we have to test for so that we can conclude that, everything in the financial statement is correct and appropriate are what we refer to as what? The assertions. The assertions can be broadly divided into three main groups. Please stay with me carefully here. You can remember the assertions also with the ACCA cover. Okay? The ACCA cover. And so we have accuracy. We have cut off. We can have classification, or maybe let me do completeness here. Then the other A can be allocation. This C will be classification. O will be occurrence. V will be valuation. E will be existence. R will be rights and obligations. So that's the ACCA cover. Those are the assertions. In other words, this is what we are saying. When we want to audit something, one way or the other, it is whether you are checking if the thing is there, if the thing is accurate, if the thing includes everything. So, for instance, if we come back to the PPE that I mentioned earlier, we are auditing PPE. Okay. If you're auditing the assets of the company, what are some of the procedures you are going to undertake? For instance, we said it has gone up, so we're going to inquire from management, right? Okay. Then remember, we said also that you're going to do physical what? Observation, to see whether the assets listed in the asset register are the assets that are actually there. And if you remember, I told you that when you are doing the physical examination of the PPEs, there are two assertions that you are trying to test for in that environment. You are testing for existence. Is what is listed in the register there? Existence. Number two, you are also testing for valuation. What is written in the book and what is there, does it correlate? Like, is what I'm seeing with what has been recorded in the books? So you realize that those two procedures coming in helping us to test for what? Existence, and then what? Valuation. Not only that, as we said, maybe the finance officer is going to say, hey, the assets were revalued and we engage a certain audit firm. Okay. Who the heck approved the valuation? That's the question we have to ask ourselves. So we need to go and find out whether the valuation really occurred. Occurrence. Did they really value it? So you want to review the board minutes or the management minutes, whether there was any resolution as to whether we should revalue the assets. That's occurrence. Then whoever they engaged, you want to inquire from the person. Did you do any revaluation? Then we obtain from the entity the valuation report. What are we trying to do? Occurrence. What are we trying to do? Accuracy. Because in the valuation report, the valuer is going to be stating the assumptions they used whilst placing the value of on the asset. So we want to check, is the assumption accurate? Can we rely on it? So if you see how we are knitting everything together, you see that auditing of the PPE, I have come with maybe 6 points already. Because we are inquiring from the finance manager the reasons for the increase in the PPE. Okay, we are doing physical examination to check whether the assets listed in the asset register actually exist. Existence. We also undertake the physical examination to evaluate whether the value of the asset in the asset register corresponds to the value of the asset that is observed or seen. Then we inspect the board or the management minutes to verify whether there was any resolution passed for the revaluation to be undertaken and why. What are we testing for? Occurrence. And since it is an asset we are talking about, you want to get the title document on these assets. What are you testing for? Rights. To determine whether all the assets in the asset register really belong to the company. It's in the name of the company. So without sweating, easy peasy, I just coughed out 6 procedures and I need 4 to excel in the exam hall. That is the connection we are trying to build here. Same thing happens if you're auditing trade receivable. What did we say? We definitely undertake analytical procedures to find out whether there has been any significant changes in the trade receivables. Okay, what else do we do? You want to take a sample of the trade receivables and send out circulars, and that is called circularization. So we send out circulars on a sample of the trade receivables. What are we trying to do? Existence. Are they really debtors, or it's a fictitious account that has been created by the company? And in those circulars, we can say, hey, our client says you owe them $50 million. Is this true? Or we can just say, hey, we are writing to you. We are the auditors of this company. Can you confirm how much you owe the client? So the response we get gives us that existence, that, hey, really, the debtors are there. And that also helps us to confirm rights, whether they truly owe the company or they don't owe the company. Because we could have trade receivables in the books, but maybe they don't owe the company, they owe the CEO or they owe the board chairman. So we are also looking at rights. Then completeness. We want to find out the list of trade receivables that we have been presented. And when we look at the trade receivables ledger control account, is that all, or does it include all the trade debtors of the entity? Is that all there is? Completeness. So this is what we are trying to talk about here. It's not like we are doing anything new. That is why I said, back to my diagram here, the assertion being tested for. Once you read a subject matter and you know, oh, I need to test for this assertion, I need to test for that assertion, I need to test for that assertion, then it will help you to then know the procedure you will undertake. The procedure you undertake provides you with the evidence. That evidence helps us to then reach a reasonable conclusion on the opinion that we can express on the subject matter or on the financial statement taken as a whole in the audit report. So come back into my slide. Let's do some crystallization there. So the assertions, as I mentioned here, the ACCA cover, okay, divided into three major groups. So we have what we call transactions and events. Stay with me. Again, so when you read the subject matter that you are about to audit, is it a transaction or an event? That's the first category. If what we are auditing is a transaction and event, then the characteristics that you would want to test for, the things that you want to confirm, the things that you would want information on as an auditor will include the following occurrence. So the entity says that the chief finance officer said, oh, during the year, the entity bought some assets. Okay. That's an event. That's a transaction. Did it occur? Okay. How do you test occurrence of asset acquisition? Maybe 2 or 3 procedures. 1, we inspect the management or the board minutes to confirm the authorization or approval of the acquisition of the assets. Because nothing can be bought without a resolution at the management meeting or at the board, depending on how much you are looking at. So if I'm testing for acquisition, a transaction or event, did it occur? So we inspect the board minutes or the management minutes to confirm the authorization or approval of the acquisition. Number 2, we request and or obtain the purchase order and the invoice that was received in respect of the asset that was bought. What are you testing for? Occurrence. I want to see. You said you bought an asset, right? All right. I've looked at your management minutes. I realized that, yeah, it was approved at the management meeting. Okay. Where is the purchase order you sent to the supplier you bought the equipment from? Where is the invoice the supplier sent to you? Occurrence. Then, as part of even the management meeting, the board minutes that we are looking at, another thing we can even inspect the board minute for is the financing option for the acquisition. Then we inspect the documents to find out how did they finance it. What are you doing? Occurrence. So we are auditing acquisition of assets by the company. From occurrence alone, we've written 3 procedures. Inspecting the management of the board minutes to confirm the approval or authorization of the acquisition. Number 2, obtaining the purchase order and the invoice for the assets that were acquired during the year. Number 3, inspecting the board or the management minutes to confirm the financing option for the acquisition. All that just under occurrence. Physical examination has not come yet. 4. Because it's an asset, so it will be there at the reporting date. That is account balances at the reporting date. So if you are auditing anything that is in the balance sheet or the statement of financial position, then you want to verify, is it there? That's what we are talking about here. So occurrence, did the thing actually take place? Completeness, does the transaction include, or whatever we are auditing, include everything that is supposed to be included for the period under review? So if you come down, you will see the one-liner definition for them here. Occurrence, transactions that are recognized in financial statement as having occurred. Did it really happen? Completeness, transactions are complete and supposed to be included and recognized in the financial statement. Have we included everything? Accuracy, we are looking at the arithmetic accuracy of it. Then cutoff, this is my favorite one. You see, we are auditing the financial statement for a certain year ended. It could be January to this, or whatever the heck the year ended of the company is. The rule of cutoff means whether the transactions in the financial statement relate solely to the year ended under review. That's the rule of cutoff. And really, where cutoff shines is sometimes when we are dealing with IFRS 15, revenue from contract with customers. And we've been talking about this as well, right? So, for instance, in accordance with IFRS 15, revenue from contract with customers, when do we recognize revenue? Revenue is recognized when a performance obligation is satisfied, meaning we've transferred control to the customer, right? Now, management can sign the contract, then boom, they will include in the statement of financial performance the revenue from the contract. It means they are breaching the cutoff rule. Because, yes, you've signed a contract, but you've not done anything. So, the revenue that relates to the next accounting year, you have brought it into this accounting year, resulting into overstating of the current year revenue. That's the principle of cutoff. We want to find out the transactions recorded in the financial statement. Do they all relate to the year ended under review, or there is something belonging to the future that have been backdated into the present? That is the rule of cutoff. Then certainly classification. Very important. Very important. So the transaction and events, have they been classified properly? So maybe during the year, the entity started a research program. Okay. In accordance with IAS 38, how should we account for research? The rule says that all expenses incurred on research must be written off in the P&L account. However, capital expenditure incurred on research must be capitalized and depreciated over the economic useful life of the asset. That is the rule. So if during the year the entity undertook a research but decided to capitalize all, they may be breaching what? The capitalization rule. So as part of our procedures, if they are undertaking research, what do? We need to inquire from management and obtain the cost elements of the research expenses. Why are we doing that? We want to find out whether it is complete, whether they really undertook the research, and whether they have classified the expenditure items well. Then you want to ask management which portion of the research expenses was written off, which option or which portion was capitalized. What are you doing? You are testing for the assertion of what? Classification. Because if something is supposed to be written off, but it is capitalized, that is a wrong classification. And in that case, profit has been overstated, assets have been overstated, and that is bad for business. That is what we mean by the assertions relating to transactions and events. So when you are auditing a subject matter, you got to ask yourself, is this a transaction? Is it something that occurred during the year? If it is a transaction or something that occurred during the year, then behind your brain, your procedures must center around, did it occur? Does it include everything that is supposed to be included? Is it at the right amount? Does it relate to the current year under review? Has it been properly classified? So once you ask yourself those questions, you flip it up to then write out the audit procedures, which will include making some enquiries, doing analytical procedures, inspecting documents, in some cases physical examination, and then ultimately recalculating or reperformance. Because you are checking the accuracy of it, so you need to recalculate what has been done already. That is what we mean by transactions and events. Then we come to the account balances at the year end. If what we are auditing is on the face of the statement of financial position, like the PPEs, trade receivable, trade payable, cash and bank balances. Okay? Then, these are the assertions you are going to be focusing on. As we have stated already, existence. Yeah, they said we've taken a loan. So you come and we are told that the bank has taken a loan from the bank. Sorry, the entity has taken a loan from the bank to the tune of whatever the heck, $40 million. What procedures do you carry out as an auditor? There is a loan of 40 million. What procedures do you carry out? Number one, did they actually take the loan? So you want to review what? The board minutes or the management minutes for the authorization or approval of the loan. Procedure number one. Procedure number two, you want to find out and obtain from the entity the loan document to understand the terms and condition, the amount, because a loan document will show you the amount of the loan, the interest, whether it is secured or not secured. And even if it is secured, what did the entity use as a collateral facility? Procedure number two. Procedure number three, you want to inquire from the bank whether the entity has actually come for a 40 million loan from the bank. I've already gotten three. You have to see how practical and easy audit procedure is. If you follow the explanation very well from last week, transporting into today. So they've gone for a loan. Yeah, we review management or board minutes. Who approved it? Who authorized it? Number two, obtain the loan documents to understand the terms of the loan, repayment, interest, collateral, and any other information. Number three, inquire from the bank whether the entity has obtained a loan. And if they have, how much was the loan? And if they have, what was the term of the loan? If they have, what was the collateral facility? We are not done yet, though. Number four, inspect the bank statement or the cash book whether the entity actually got this money deposited into their account. Yeah. Because we can see the loan document. We may have asked the bank and they say, yeah, we've given them a loan. But you want to check the cash book or the bank statement. Where is it? Where is the 40 million in the account? Because maybe the company went for a loan, but it ended up in the account of the MD. As auditors, these are the things we love. These are the things we question. Is it in the account of the entity? So again, without getting goosebumps, I have my four procedures. But I've not ended there. If I'm excited, I could add one more. Inquire from management the reason for the loan. Yeah, it's a procedure. What did you want to really finance the loan with? And then we follow up with a procedure to confirm whether the loan was used for the intended purpose. Again, this thing is easy. It's a 20 marks area. That's why I am trying as much as possible to present it, repeat the same idea, because it's a done deal. The only thing is we don't know the subject matter issue. But no matter the subject matter issue, this is what you come with. All right. So existence, pretty important, right? For assets. As I mentioned earlier, the asset, do they belong to the company? So you attended an inventory count. You want to find out the closing inventory that the entity has recorded. Do they all belong to the company? Because as we said last week as well, they may have sold the inventory, but the customer had not taken possession yet. So the customer says, oh, keep it for me, I'll come for it later. And they have counted it as part of the closing inventory of the entity. Or they are keeping the inventory for another supplier. So maybe they have a bigger warehouse, so someone else comes and say, oh, can you keep this inventory here for me? And they have counted it as part of their inventory. So we want to find out all these inventories, do they belong to the company? That is right. Because remember, when closing inventory is overstated, what happens to profit? Profit goes up. What happens to the statement of financial position? The asset base goes up and the gearing effect of the entity is going to reduce. Right. Obligations are about liabilities. So anytime we are auditing liabilities, you want to find out, is it the entity owing or someone else owes? So yeah, we have seen in the board that we are going for a loan. But was the loan given really to the company, or the loan ended up in the private account of the board chairman? Who really owes the debt that is on the face of the statement of financial position? So you are auditing trade payables. Sorry, you want to confirm, is it payables that the company owes? Because board chairman can buy something and can give instruction to the finance officer to put it on the company's books. So as auditors, when we come, the fact that you are seeing trade payable doesn't mean all the trade payable are for the company. So we need to dive deeper. That's obligation. So rights relates to ownership. So that's why we're going to review title documents. We're going to review lease contracts to find out who is the lessee, who is the lessor. Because if the entity leases an asset from the board chairman or from a key management personnel, then that is a related party transaction. In accordance with IAS 24, related party transaction disclosures, we are supposed to disclose such transactions in the books of the entity. So have they disclosed the lease of assets from the CEO in the notes? If they have not, that may be material. Why haven't they? That's what we are trying to do here. Completeness, we've already said that. So whatever. If it is trade receivables, are these all our debtors? If it is trade payable, are these all our creditors? If it is PPE, are these all the list of assets? If it is inventory, are these all the inventories we have as a company? Then valuation and allocation, we've also mentioned that. Because once you are doing existence, you are observing, you are also estimating the value that has been placed on the item. So anytime we are auditing something, a subject matter that is in the statement of financial position, at the back of our mind, again, is it there? At the back of our mind, does it belong to the company, or is the company the one owing? At the back of our mind, does it include everything that is supposed to be included? At the back of our mind, is the value at which the item being carried the right amount at which it should be carried? These are the assertions that will be running at the back of your mind. Then based on those assertions, A, E, I, O, U, you will now write out your 4 audit procedures. So that's the second category, accounts balances at the year end. Then suddenly you come to presentation and disclosure, same ideas, because disclosure, the notes to the financial statement is part of the financial statement itself. So we want to find out, have they disclosed whatever that is supposed to be disclosed? Is it complete? Were there any omissions? These are the characteristics that we need to test for to ensure that the financial records and disclosures are correct and appropriate.